Hey everybody, Steven Sitkowski here. Welcome to this week's edition of Market Insights. It is September 23rd. Share my screen with you. Hope everybody is doing fabulous. Quick reminder, everything we do here is for educational purposes only. It is not intended as investment advice. I'm just kind of sharing with you some of the things that I've discovered researching the market. So what's moving the markets? The Fed cut rates for the first time in 4 years. Not surprising. That was expected. What was a little surprising, I really thought they'd cut 25 basis points. They cut 50 basis points. That's a 0.5%. So that's what is known as a fast start when it comes to rate cuts. Powell seemed to be very comfortable with the idea of a soft landing for this economy. So I'm hearing the recession word more and more. It's not what the Fed is saying. The Fed's mandate shifts away from inflation. They think they've got that pretty much wrapped up and towards jobs. They want to make sure that the unemployment rate doesn't get a whole lot higher. Right now it's at 4.2%, forecasted to be 4.4% at the end of the year. They don't expect it to be above 4.4% throughout 2025. 10-year Treasury is at 3.739, just fine for equity investors. And oil price is pretty steady at around $70 per barrel. Quite a bit of news coming out this week. So a lot of Fed speak on Monday. We had our PMI numbers come out, both services and manufacturing. I will tell you, manufacturing really disappointed. Manufacturing is in contraction. Tuesday, consumer confidence. Let's find out how people are feeling. Wednesday, new home sales. That is not significant. A whole bunch on Thursday. So we've got initial jobless claims. That's a biggie. We're expecting 223%. Durable good order. We're expecting that to have fallen a bit. The second revision for GDP supposed to come in close to 3%, and then a bunch of Fed speak. And then on Friday, another big news days. We have personal income, personal spending, PCE, one of the Fed's favorite inflation indicators, personal consumption expenditures. And then again, an idea of how the economy is doing with wholesale inventories. And then we get the final consumer sentiment number. So a big week to be watching. Market breadth last week was fabulous. 792 stocks hit 52-week highs on the New York Stock Exchange. Only 27 hit new lows. On the NASDAQ, 751 compared to 275. Last week's heat map. So NVIDIA didn't fare well. Financials did great. Most of semis and software companies did well. Big tech, Microsoft, Apple, and then a communications side, Alphabet, formerly known as Google. Meta had a huge week. Amazon, a good week. GE did great. Caterpillar, and the energy patch did well. 1 year heat map, it is still NVIDIA and everybody else. Video of the year is up 174%. But there were a lot of other great performers. Broadcom, 100%, AMD, 55, Qualcomm, 54, JP Morgan, 42, Amazon, 42, Walmart, 44, Costco 64. There's money made all over the place if you knew where to look. Third quarter, we saw some rotation. Look what was up. The S&P equal weight. Look what was down. Semis and the NASDAQ. So things shifted a bit. Last week, big winner. Constellation Energy went up 30%. Why? They own 3 Mile Island, which apparently is going to get reopened, and they're going to sell electricity to Microsoft for their AI plant. Vistra up 26%, CrowdStrike, Airbnb, Intel. Intel's been moving. Carnival, Hewlett Packard, Capital One, Nike, PayPal, all had returns of 9.5% last week or more. Earnings are headed higher. By year end of 2025, they're supposed to be at 18%, which would indicate the market ought to be up 18%, everything else being equal, and it's never equal. Buybacks are at an all-time high. So this is where companies take money out of their treasury and buy stock, which benefits existing shareholders because it shrinks the number of outstanding shares. Labor markets definitely weakening, and this is why it's got the attention of the Fed. Market sentiment, pretty strong. Typically independent investors are 37.5% bullish and 31% bearish. Now, 50.8% bullish, 26.4% bearish. Do we have room to run in this market? So what you're looking at are all the bull runs that we've had going back to 1957. See the red? That's where we are now. In the words of Karen Carpenter, we've only just begun. And that's why she made all the money singing, and people only pay me to stop. So, kind of interesting. The next Fed meeting is November 7th. There's about a 50-50 shot right now that we will get another 50 basis point cut. So that'd be the Fed really stepping it up. How do markets react to rate cuts? They go higher unless we go into recession. But the Fed, they don't think we're headed for a recession. 1-year sector return, so the S&P 500 is up 32.29%. What has beaten? Technology by a bunch, 48.67%. Communications is beaten by 6.5%. Financials, a couple of points better. Industrials off a little bit to the S&P, but it doesn't start getting really ugly to get all the way to the bottom. Energy, for the last 12 months, if you put your money in it, you wouldn't have made anything. Let's take a look at the charts. And let's begin with the S&P. So that'd be the SPX. And the chart looks great. The thing that I've pointed out with you is that resistance level, we've exceeded it. We've broken the ceiling. And we are off and running at this point. How about the Qs? So the Qs are well above the 50-day moving average, but 50-day moving average is kind of sloping down. And we're up against a former resistance level. So this is going to be a kind of hide and watch. And the Russell 2000 has been pulling back the last 3 days. Money has come out of here to go into big tech. By the way, our track record on closed trades so far this year, Pretty darn impressive. This is on our trade ideas. So we have closed 74 trades, average return 18.9%, average holding period 19.2 days. So about 1% per day. All right. Well, good being with you once again. I will see you next week. And until then, be safe, be blessed, and bye for now.